Hi, I'm Carolyn Coffey, and this is my presentation on BUUU Group Limited and their IPO. I'm just going to preface this by saying that my computer on my keyboard on my computer is not working. It's not connecting, so I only have touchscreen and I can't type anything. So I was actually unable to finish my presentation. I've only gotten about 90% done. If I can fix it before the due date, I will turn in the full thing, but if I cannot, this will have to do. Um, and then hopefully, maybe you'll accept it, a completed one by tomorrow. So this is my presentation. I also can't fully present it because I don't have an escape key and I can't get out of presenter mode and move on to different slides. So I'm just using my touch screen, and my touch screen is a little slow. So moving on to the market overview is differences between the exchanges. The Nasdaq is completely dominated by the tech industry and biotech industry. The Hong Kong insurance market is dominated by real estate. The SSE is dominated by state-owned enterprises and domestic industries. The New York Stock Exchange and the London Stock Exchange are prestigious, but they have high listing standards. Nasdaq and NSE are more accessible for emerging companies. And then the New York Stock Exchange, NASDAQ, and London Stock Exchange are open to all global investors. Moving on to the similarities between the exchanges, all of them have advanced electronic systems. Each is governed by national financial authorities. All markets serve as platforms for companies to raise capital through IPOs and secondary offerings. Finally, the global reach allows the exchanges to reach international investors, but the reach may vary. So BUUU has only had one exchange, and that is the one I'm talking about. It's on August 14th, 2025 in the NASDAQ market, where they grow 6 million through 1.5 million Class A ordinary shares at $4 per share. And this was only in the United States. To affect the IPO decision and why they didn't go global is that there's higher rates caused by the US Federal Reserve hikes that reduce IPO attractiveness, and increase borrowing costs. There's a lot of inflation in 2025. There's also a lot of geopolitical tensions. Sorry, I'm having a hard time talking. With conflicts in Ukraine, the Middle East, and many trade disputes like the US and China tariffs. There's stricter IPO vetting in China and ESG scrutiny in Europe. And then volatility in Asia and Europe contrasts with the resilience in US and India. AI and tech optimism are currently driving IPO interest in NASDAQ and NSE 10. This I was not able to do. I can't remember the prompt off the top of my head. And then the boom and bust cycles, they affect both individual and collective markets. Individually, individual markets have increases in home buying and loans during a boom. An example is the early 2000s US housing boom, and during a bust, individual markets have higher unemployment and lower spending like COVID-19. I wasn't able to do the collective market impact. Continuing with social climate, and then public opinion shared through news and social media can affect markets through boycotts and online trends that can increase or decrease a company's profit. Political climate, tax policies, tariffs, and new regulations can affect market performance and returns. An example of uh, social climate is Brexit, and the London Stock Exchange had a decline in listings and decreased investor confidence. And then political, India's elections, it boosted India's national stock exchange performance because of the country's pro-business sentiment. For the relationship between interest rates and lending, central banks tend to use interest rates to combat inflation. So higher rates result in reduced borrowing, which results in lower spending, which results in slower inflation. An example of this is the U.S. Federal Reserve raised rates in 2022 and 2023, which cooled the housing and tech sectors. Another example is that of the European sovereign debt crisis, which raised interest rates, resulting in stock market declines and less investor confidence. Sorry, I'm having a real way with my words today. So to see the boom and bust cycle in stocks, stock prices rise because of strong earnings, optimism in investors, and economic growth. IPOs have a higher demand because companies can raise more capital. 2021 saw record IPOs during post-COVID recovery. In terms of the bust cycle for stocks, stock prices fall due to recession fears and lower earnings. Investors avoid risk for IPOs and they are delayed or priced lower. Example is the 2008 crisis. And with rising interest rates, oh, that should be over there. But rising interest rates result in lower bond prices. The boom cycle, low yields, investors prefer equity, minimal direct impact on IPOs, but companies prefer equity over debt financing. Bust cycle, bonds become safe havens, prices rise, and yields fall. Investors shift away from IPO towards bonds for safety. And then in terms of their inflation and interest rates, high inflation erodes bond returns and rising interest rates and lower bond prices. In terms of, I already put that there. In terms of mutual funds, we have the boom cycle, which equity mutual funds see inflows, and there's more investors. Mutual funds often participate in IPOs, boosting demand. The bust in a mutual fund um, shift to bond or money market funds. Equity funds see outflows, and there's reduced support for IPOs. Next, we have commodities, which in the boom cycle, prices rise due to increased demand. Higher valuations in IPOs, prices fall in the bust cycle, and there's less IPOs. In this presentation, we'll be talking about the Hong Kong Stock Exchange compared to NASDAQ. And this is a statement on why BUU should have considered or could have considered the Hong Kong Stock Exchange. BUU is based in Hong Kong. The Hong Kong Stock Exchange is a leading venue for Asia-Pacific listings, specifically for companies with Chinese operations. Strong investor base familiar with the MICE meetings, incentives, conferences, exhibitions industry. However, Hong Kong has increasingly strict listing requirements, and the IPO market has been volatile due to recent geopolitical and regulatory pressures. To kind of look at the rules and regulations of Hong Kong Stock Exchange, their frontline regulator, they have I'm not sure what this slide is. Okay, we're gonna skip this. Oh, okay. And something that the Hong Kong Stock Exchange requires is that it must meet 14 core shareholder protection standards. They're required to comply with Hong Kong's corporate governance code, including board independence and diversity, mandatory director training, disclosure of board performance, and caps on tenure. In terms of their financial reporting and transparency, issuers must allocate adequate resources to financial reporting. Later incomplete filings can trigger regulatory scrutiny, and Hong Kong emphasizes timely disclosure and audit integrity. These are reasons why BUU likely considered NASDAQ over the Hong Kong Stock Exchange and why they likely didn't choose it. Comparing the two companies directly, NASDAQ companies must disclose their governance practices but have more flexibility in board composition and structure compared to Hong Kong companies who have to disclose their board performance reviews and skills matrix. In Hong Kong, companies must engage a licensed sponsor, usually a bank, responsible for due diligence. Sponsors can face criminal liability for misstatements in prospectuses. This does not happen at NASDAQ. Moving on, we have the statement for why BUU chose NASDAQ. Simplified listing process, no need for a sponsor with criminal liability, greater flexibility, access to the U.S. capital markets and global investor base, strategic alignment with expansion goals in the U.S. and Southeast Asia 4. BUU has plans to expand more in the United States. More challenges with Hong Kong. It's complex and costly, strict governance, potential need to restructure corporate entities to meet compliance, and competitive and saturated local market. Moving on to the different markets, my statement is that BUU should not have considered listing in more than one market. This is because BUU Group is because dual listing in Hong Kong and Nasdaq could have increased visibility in Asia. Or sorry, the pros is because dual listing could have increased the company's visibility in Asia, attracted regional investors, and enhanced liquidity and valuation potential. The cons is that as a mid-sized company, BUU may not have had the resources to manage dual compliance. Hong Kong's strict governance and sponsor requirements could have added complexity and cost. Nasdaq offered a simpler, more cost-effective path to global capital via Form F1 registration. Comparing United States and Hong Kong market interests, the Federal Reserve in the United States sets the federal funds rate, which influences borrowing costs across the U.S. economy. The FOMC meets regularly to adjust rates based on inflation, employment, and economic growth. Dual mandate, maximum employment, and price stability are the goals. Hong Kong Monetary Authority does not independently set interest rates. They use a linked exchange rate system. As a result, the HKMA's base rate tracks the U.S. interest rate changes. Hong Kong's interest rate policy is reactive, not proactive, and is influenced by U.S. monetary decisions. To lower rates, it results in cheaper borrowing for businesses and consumers, higher stock prices, increased IPO activity, and weaker currency. An example of this is COVID-19, when the Fed reduced interest rates to near zero, which resulted in a surge in tech stock valuations, record IPOs like Airbnb and Snowflake, and increased investor risk appetite. If rates are raised, it results in more expensive borrowing, slowing down investment and consumption, lower stock prices, reduced IPO activity, and stronger currency. When the Federal Reserve raised rates aggressively to combat inflation, I can't remember what year this was. I want to say 2011, but I may be wrong. This led to a sharp decline in Nasdaq and tech stocks, many IPOs being postponed or withdrawn, and increased bond yields and investors shift to safer assets. Looking at dividend yields compared to Nasdaq in Hong Kong, currently Nasdaq is at 1.2, which reflects a focus on growth-oriented companies. Hong Kong is 2.49, which is more attractive for income-focused investors. Capital gains in Nasdaq are 15% average annual gains, driven by tech and innovation. Hong Kong is 8% slower, but it's more stable. Nasdaq price to earning indicates higher valuations. Hong Kong is 18 compared to the Nasdaq's 25, which is closer to fair value, appealing to investors. In terms of the foreign exchange risk, Nasdaq has a low risk, stable currency, global reserve. Hong Kong has a moderate risk that is pegged to USD, but is sensitive to its capital flows and geopolitical factors. Looking more at Nasdaq, we see it has strong capital gains and high valuations that reflect investor appetite for growth and innovation. Its lower dividend yields indicate a focus on reinvestment and expansion. Its stable currency reduces foreign exchange risk for international investors. It's ideal for companies in tech, consumer services, and emerging industries, much like BUU. Higher dividend yield in Hong Kong appeals to income-focused investors. It has moderate capital gains, which suggests more conservative growth. Its valuations are closer to intrinsic value and may affect investor value. Foreign exchange risk is higher due to geopolitical and capital flow sensitivity. This graph just shows the comparisons between the dividend yields, capital gains, price to exchange ratios, and foreign exchange risk between the two markets of Nasdaq and Hong Kong. The impact of IPO listing decisions and why a company might choose Nasdaq over Hong Kong is to maximize its capital gains and attract growth-oriented investors. The global visibility of Nasdaq and its deep liquidity, to avoid its complex governance and sponsor requirements seen in Hong Kong. A perfect example is BUU Group choosing Nasdaq over Hong Kong. And why a company might choose Hong Kong is to target its regional investors familiar with the industry. It's also a company from Hong Kong or from China to benefit from higher dividend expectations and valuation stability, and it's suitable for companies with strong local operations and long-term income strategies. The advantage of NASDAQ is that it's faster and higher returns. It's attractive for companies in tech. It's ideal for firms like BAU Group seeking rapid growth. The advantages of Hong Kong is that it has a strong performance in commodities suitable for resource-based or industrial firms. Higher dividend yields and valuation stability appeal to long-term investors. The instrument performance trend suggests that Nasdaq is better suited for equity-driven IPOs, specifically in growth sectors. Hong Kong may be more favorable for companies in commodities or those targeting income-focused investors. Understanding these understanding these dynamics helps companies align their industry strategy with investor expectations and market behavior. So, looking at the stocks of Nasdaq and Hong Kong, the stocks of Nasdaq have higher returns of 15%, but also higher volatility. Hong Kong has lower returns of 18% and a lower volatility of 12%. The Nasdaq is better for growth-oriented IPOs, and Hong Kong suits conservative equity investors. This is another example of why BAU did not choose Hong Kong. In terms of bonds, they're similar. The Sharpe ratio is equal, and the bonds are not a major factor in the IPO decision made by BUU. The Nasdaq has higher returns in terms of mutual funds. Hong Kong has lower returns, and because the U.S. mutual funds may be more aggressive and growth focused. In terms of commodities, Hong Kong has higher returns, and well. Put here the Nasdaq has slightly lower returns at 10%, but it should be slightly higher returns at 12%, and Hong Kong has a high volatility of 20%. Hong Kong is attractive for commodity-based firms, but the risk is higher there. In terms of interest in inflation, Nasdaq is best for companies seeking rapid growth, high valuations, and exposure to tech-savvy investors. Hong Kong is better for firms in commodities, infrastructure, or those targeting dividend-focused investors. Example of a NASDAQ decision is BAU Group, focused on MICE services and tech integration, and chose NASDAQ likely due to faster equity returns, higher investor risk tolerance, and strong mutual fund and institutional support, which we just saw in the last slide. Example of a Hong Kong decision is RMB currency futures, which grew 43% year to year over 115,000 contracts. The significance is that it reflects rising demand for RMB-dominated instruments and hedging tools. The impact on its listings, firms with cross-border operations or RMB exposure may benefit from enhanced investor tools and risk management options. And this was as far as I got. I was going to make a chart for the taxation, but to give a little summary, Hong Kong offers a more tax-friendly environment for IPOs, especially for companies with international operations. The U.S. listings provide access to deeper capital markets, but come with higher tax burdens and compliance costs. The trade-off between tax efficiency and investor access is essential to the IPO strategy. So this is my presentation. I'm sorry it was a little bit funky and messy. It's not totally done. But I hope you accept this. And I also apologize that I was a little bit messy in my speech. It's been a long day. So thank you so much. Have a good night or morning. Bye bye.